if we're a long way from achieving the inflation goal and the economy is now so strong that they're not even worried about a recession, why would they talk about rate cuts as early as next year?
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar.
The big topic that I want to discuss today is what happened on Wednesday with the Fed, because the Federal Reserve announced its decision on interest rates. And after a pause, remember the last time the Fed met, they didn't do anything. They left interest rates alone. And at that time, I thought that that was it, that the Fed paused because they were worried about the damage that had been done by the rate hikes and that they didn't want to hike anymore, but they didn't want to come right out and say that. They still wanted to, kind of fake as if they were going to keep hiking, but they came up with an excuse to pause, and I thought they may prolong that. Well, that was wrong, because the Fed did, in fact, raise rates again, another 25 basis points. We're now at 5.25 to 5.5. And I think one of the reasons that the Fed was able to slip in another rate hike was because of the huge rise in the market. Now, I think one of the reasons the market was so strong is because a lot of people jumped to the same conclusion as me, that the Fed was kind of done. And so the market rallied. It was like a relief rally that the rate hikes might be over. But I think that big rally in the market created a sense of comfort for the Fed that, we could slip in another rate hike. And in fact, going into the decision, the odds of a rate hike were near 100%. So, of course, by then, I was pretty much of the view that we were going to get a hike. I no longer believed that the Fed was done, because one thing I've learned over the years is the Fed never wants to surprise the market. So if the market is certain the Fed's going to hike, well, the Fed hikes. The Fed doesn't want to surprise the market, disappoint the market, give the market a reason to be concerned. After all, if the Fed didn't hike, the markets might have thought, why not? Why didn't they hike? What's the problem? What are they worried about that we don't know about? So when the markets are kind of blessing the rate hike because everybody believes the Fed's going to hike, and then, the markets are going up anyway, there's no reason for the Fed not to hike because it can kind of get it in. But the question is, what's going to happen next? Because Powell is still indicating that there's one more hike. But that's really it. And whether or not we go from 5.25, 5.5 to 5.5, 5.75, I don't think that really makes much of a difference. But it's pretty clear from what Powell said, not only in the prepared remarks, but in the press conference that followed, that this is pretty much it. Because Powell mentioned in that Q&A that they don't expect any rate cuts this year. Well, the year is half over, right? We're, next week we're starting August. And so the fact that we're not going to get any cuts this year shouldn't surprise anyone. But what Powell did indicate is that the members of the FOMC believe that the rate cuts are going to start next year in 2024. So I think that's pretty dovish to let that cat out of the bag, that we're going to start cutting rates in 2024. And, it doesn't even make any sense for the Fed to even suggest that rate cuts could come as early as next year, when the Fed also removed from their forecast a mild recession. The last time the Fed met, they had a recession in their forecast, which is something they never do. Now, they kind of clarified it by forecasting a mild recession, but they still forecast a recession. They've now changed their mind. According to Powell, based on the economic data that has come out since that forecast, the economy now looks strong enough that the Fed's base case is now a soft landing where the economy avoids recession. We don't even have a recession, and we don't even have any kind of big pickup in unemployment. Well, if that is really the case, if the Fed thinks there's no recession anywhere in sight, and according to Powell, we're still a long way from reaching the 2% inflation goal. He said many times that inflation is still too high. It's a threat. It is, eroding purchasing power. It is hurting the middle class. It's hurting the poor. We're a long way from victory. Given that, if we're a long way from achieving the inflation goal, and the economy is now so strong that they're not even worried about a recession, why would they talk about rate cuts as early as next year? Also, I think the most significant announcement that came out of the meeting is that Powell admitted that the Fed is not going to wait for 2% inflation before it starts cutting rates, because Powell said we don't believe we're going to get back to 2% inflation until sometime in 2025. But he said the Fed is forecasting the first rate cuts to happen in 2024. Well, why cut rates if you're still not at your 2% goal? Well, what Powell tried to say is that we don't have to wait for 2%. We will just assume that if we've made enough progress and we're moving in that direction, well, we'll just start cutting rates anyway, and we'll just assume that the prior rate hikes have got us on a glide path so that we can still get down to 2%, even if we start cutting rates, which makes no sense. In fact, Powell admitted that the Fed is still restrictive in its policy, but that by next year, it may not only move to neutral, but move to accommodative. He said we may lower interest rates to below neutral next year. How are they going to do that? We're not even close to the inflation goal. Yes, if you look at the headline CPI, we got down to 3%, but it's not going to stay there. Oil prices dropped almost 50% between, I think, the summer of 2021 and about 2-3 months ago. It was about a 50% drop in oil prices. That was really what brought headline CPI down from 9% to 3%. Well, over the last 3 months or so, oil prices are up 25%. We closed the fifth consecutive positive week for oil. We closed above $80 a barrel. Gasoline prices now in the country are at the highest they've been all year. We're seeing other commodities that have already turned. The dollar index is weakening. It's bounced, it's back up to about 101, but the dollar is in a decisive downtrend. Everything that you're looking at, all these forward indicators suggest that inflation is going to get worse, not better, that the days of falling inflation are behind us, and we're now about to embark on higher inflation. So with that in mind, how is it that Powell can be talking about cutting rates as early as next year? Not only not raising rates, but cutting them. In fact, Powell said there's no way we're going to keep raising rates until inflation is down to 2%. He said we would way overshoot if we did that. We have to start cutting rates even before we get to 2%, supposedly to prevent inflation from getting too low, which of course is never going to happen. I think that there is another reason why Powell wants to tell the markets that rate cuts are coming, that don't pay any attention to the hikes today. We want you to think about the cuts that are coming tomorrow.